Okay, now let's discuss moral hazard and adverse selection. Let's start off our discussion with moral hazard first, then we will get into adverse selection. So, what is moral hazard? Actually, what happens is when you have insurance, you kind of get comfortable knowing that you have that protection and you do things which you otherwise would not. For example, let's say you're an individual and you get a insurance for your home against burglaries, thefts. So since you know that God forbid if there is going to be any theft in your house, or if there is going to be a burglary in your house, you can claim insurance. What you will do is you might leave the door open at times, you might not even get a security system installed. So these type of things is referred to as moral hazard. Somebody who might have health insurance might be a little bit careless about their health. They might even visit the doctor more frequently, take more medicines than they would otherwise take, because since the insurance company is paying for the medicines. So this actually happens and it is very, very normal. People do this, and therefore it is more of a concern for property and casualty insurance and health insurance, but not a major concern for life insurance, because obviously in order to claim life insurance you have to die, right? And obviously nobody wants to die. So this moral hazard is more of a concern for property and casualty and health insurance. Now, how do insurance companies go about trying to reduce moral hazard? Number one, you can have deductibles. What does that mean? That if, for example, there is any claim on a health insurance policy or a property and casualty insurance policy, the policyholder bears the first part of any loss, right? So that obviously discourages them to try that encourages them to mitigate any possibility of losses, right? Co-insurance, which means the insurance company will only pay a certain part of any loss. Again, that reduces the burden on the insurance company and increases the burden on the individual, and therefore they would try and mitigate any possibility of losses. And then of course a policy limit or a cap, which is having a maximum amount that can be claimed on any of these policies. Now let's move on to adverse selection. Now, if we take the example of a car insurance company, which is giving the same price, the same rate to everyone, whether they are having good driving skills or bad driving skills, is not a good strategy. Why? Because the people who are having bad driving skills will find the rates more appealing, and the company will select bad risks, which is why this word adverse selection is there, that the selection of the clients for the insurance company is not done very well over here. How can we reduce adverse selection? Well, on a case to case basis. If you're, for example, talking about health insurance, then what you should do is medical checkups and then determine how much premium you should charge. So if somebody is not taking care of their health, naturally you want to charge them a higher premium, and if somebody is fit, very fit, and very conscious about their health, then you should charge them a lower premium. Similarly, if you're talking about auto insurance or car insurance, you could check their driving behavior, and there are lots of various ways of doing that, and then accordingly you can quote them a premium. Now let's move on to regulation. And as you have seen in banks in the previous reading videos, that they have a complete centralized, globally centralized committee. But unfortunately, up till now, there is not one for insurance companies. There is one in the making, and hopefully soon it will be there. But currently, it is not a global regulatory system for the insurance companies. What we have is regional. So, for example, in the European Union, there is Solvency II, which applies to all insurance companies. And Solvency II has two things, which is MCR and SCR. So MCR is the minimum capital requirement and SCR is the solvency capital requirement, and the MCR is typically set between 25 to 40% of the SCR. So obviously the SCR is the bigger one over here and the MCR is like within the SCR. So first, obviously, if the capital starts to fall, it will fall below the SCR first. And if it does fall the SCR below the SCR, then what the insurance company has to do is naturally bring it back to the SCR level. But if it continues to fall and even falls below the minimum capital requirement, then that is obviously a serious thing. And as per this regulation, the Solvency II, what will happen is that the insurance company cannot write any new policies, which means it will be prevented from taking any new business, and even its existing policies may be transferred to another company. Right? How is this calculated? Well, number one, we have to see what they are doing with the premiums that they are getting in terms of investment. So where they are investing. So what does the asset side of the balance sheet look like? Number one. Number two, and before I go on to number two, of course, we have to see how risky the assets are. So the higher the risk, the more risky they are, the more the minimum capital requirement and the more the SCR will be. So if you're investing in stocks, naturally you will have to have a higher capital to be able to do that. Now, the underwriting risk, again, what is the risk of the policies that you're writing in terms of adverse selection? Are you really going for the risky policies? So naturally, there is a list to the risk to the liability side of the balance sheet that your payouts could be much higher than you're anticipating. So if the liabilities are going up and the assets are going down, that means that you have very risky assets and very risky policies. So therefore, to offset this, what you have is your equity, which needs to be substantial to be able to balance this difference, because you want to keep this equation balanced, which is assets is equal to liabilities plus equities. And the third thing over here is your operational risk, which means in terms of if you go back and when we were talking about the banking operations in the previous videos, what we talked about is internal and external, and there's fraud and there's mistakes and errors and cyber risks involved. So all that kind of stuff comes into insurance as well, because errors can be made here as well and fraud can be done here as well, and cyber risks are applicable to insurance companies as well. So what they will do is basically take the different business lines, and then the more risky business lines will have a certain percentage which will be more than the safer business lines. That has to be kept as capital. So how do you compare the capital requirements to the different types of insurance businesses? So for instance, property and casualty will have a higher capital requirement than life insurance. And why do you think that is? So life insurance business is very predictable, because remember the mortality tables we discussed. They are very good in terms of their accuracy, because we have such a large sample size and we have this huge history of data, and we can, with a very high degree of surety, try and predict these mortality and longevity situations. But with property and casualty, the problem is that there is a lot of exposure to catastrophe risks, like earthquakes or like we talked about earthquakes, and what else did we talk about? Mm, let's just go back and check. What was it? It was hurricanes, yes, earthquake and hurricanes. So that's the problem with your PNC, that they have exposure to catastrophe risks such as earthquakes and hurricanes. Therefore, they need to have a higher capital, because catastrophe risks are a greater concern than longevity and mortality risks, which are more predictable. How about in the US? So like we have in Europe, the Solvency two situation, right? So in the US, we insurance is not regulated at a federal level, right? Like we saw in the case of banks, that banks are regulated at a federal level. Insurance in the U.S. is regulated at the state level, which means there's a different regulation for California, a different one for the New York State, and so on and so forth. So how does this work, and what are the important points over here? Remember that we talked about regarding banks that they have an insurance for the deposit, which means, and it was, if you remember, $250,000, $250,000 per account is guaranteed in case the bank goes bankrupt. Your deposit is guaranteed to the amount of $250,000. That's not the case specifically with insurance, because what the real difference over here is that for banks, they don't wait for the bank to go bankrupt. They actually pay the premiums and keep this fund, which is there, which will help to compensate for losses. So the Federal Deposit Insurance Corporation is already getting the premiums which are being paid by the banks, and it's already ready to pay this out to the depositors in case any bank goes down. With insurance companies, it's a little bit different. So there is no such permanent fund that exists. Insurance companies only make contributions when one of them goes down, right? So they all do make contributions, but only when one of them goes down. So if insurance company fails, then what will happen is that the other insurance companies operating in the state, only in that specific state, then will be required to contribute to a fund, and this fund will be used to compensate the policyholders. However, it's not guaranteed again, so there may be a limit on how much could be claimed, and there could be several days worth of, even weeks and months worth of delays in the settlement. So that was it for your regulation concerning insurance in the US. It's at a state level. Now let's go through the summary for this entire chapter. Number one, what are the different categories of insurance companies and what are the risks that are facing them? So we talked about three categories: life insurance, property and casualty, and health insurance. And of course, moral hazard is something we talked about, that people start slacking when they have that risk coverage, and insurance companies might not be able to differentiate between good risk and bad risk, and that's why they face adverse selection issues. Life insurance companies are obviously having the problem where whatever their probabilistic analysis is of how long somebody is expected to live, if they live longer than that, then that's a longevity risk. If they live shorter than that, that's a morality risk. So we're not really going to be happy with either, right? What we want is to be right with our statistics. And for property and casualty, obviously, we're concerned about catastrophic risk or catastrophe risk. Think about hurricanes and earthquakes. Insurance companies obviously receive premiums, and they invest those premiums. Those investments go up and down because of market, and the bonds can also default, and therefore there is credit risk in those investments as well. How do you use mortality tables and to calculate the premium, the break-even premium? So we talked about this as well. And how we do it is that we calculate the probability of death within a certain year, and the probability of survival till a certain age, and then we multiply that by the we multiply those two together, and then with the amount of the payout, and then we know the expected payout, and then we can equal that to the present value of the expected premiums, and that's how you use the mortality table to calculate a premium payment. How is mortality risk different from longevity risk, and how can you hedge these risks? So first of all, I mean, if you're in the business of life insurance, mortality risk is bad, because if somebody passes away earlier than you thought, then you will have to pay a big payout before you were expecting. So this is definitely bad for the life insurance business, but it's good for the annuity business because then you don't have to pay those payments to that person anymore. However, if somebody is living longer than you thought, then this is bad for the annuity business because you have to keep paying that person. But it's good for the life insurance business because then you keep getting the premiums from them and they are living longer. Now, if an insurance company offers both life insurance and annuity, to some extent, they will offset each other, but not completely. So there will be some remaining risk or residual risk, which you will have to manage using longevity derivatives or longevity bonds, which basically take the difference between the expected uh, longevity risk or mortality, basically the expected um, life duration. So let's just call it mortality minus the actual, right? And either you can have a derivative based on this, which will just take this difference and multiply it with a certain nominal value that which you can have, or you can have a bond that pays a coupon or a principal, which is either you can have the coupon of this bond or the principal of this bond linked to this formula over here. So both the options are there. Then we also talked about pension plans and how a defined benefit plan is different from a defined contribution plan. So, in a defined benefit plan, the employer is taking a certain amount of risk by guaranteeing a certain pension to its employees based on a certain formula. This is obviously risky for the employer because they have to make sure they are able to pay this. In a defined contribution plan, the employer is having it easy because their contribution is defined. What happens to that contribution is then the employee's choice, and that's why the employee bears the investment risk over here depending on what they choose, if they choose a easy or a low risk investment or a high risk investment. So in a defined benefit plan, obviously, since the employer is managing it, they will pool all the contributions together and manage it in a very nice way. In a defined contribution plan, since the employee is choosing what type of level of risk they want, so you will of course have to maintain separate accounts for each employee. What are the different types of life insurance policies? We talked about the whole life insurance, which is having a guaranteed payment whenever the policyholder passes away. With respect to that, term life is different because this is only for a specified number of years, which means if you pass away before that, then you get a payout. Otherwise, you will not get any payout and all that premium will go to waste. Endowment life insurance is also having a guaranteed payout, and here there are some very interesting investment options that are there. Group life insurance can be done without a health check, and the reason is because a large number of individuals are pooled together, so the insurance company knows they'll be getting some good risks and some bad risks, so they don't bother doing the health checks. Then you have the opposite of life insurance, which is annuity contracts. Here, instead of giving premiums and then getting a lump sum at the end, what you do is you give a lump sum in the beginning and then you get premiums until you are alive, right? So you get regular payments for the rest of your life. These have two options: either it can start immediately or they can be a deferred annuity contract as well, which might start after a few years of you making the payment. Then we talked about the different ratios for insurance companies, specifically property and casualty. So number one, if you're getting $100 in premium and you're paying out $70 in your policy payouts, right? That means this is your loss ratio, which is 70%. Then whatever is your selling expense and verification expense, so let's say that is another 26%. So this will get added and your combined ratio will then be 96%, right? Then you have to pay dividends as well, and let's say you're paying 1% of your premiums out as dividends, so then your combined ratio after dividends will be 97%. However, since you're receiving the premiums at the start of the year and then you don't have to pay out the payouts and then the expenses until maybe sometime later during the year and at the end of the year. So you are able to earn interest on that interest income, and let's say that is 2%. So that will be subtracted from this expenses again, and what you will have is 95% as your operating ratio, which means 100 minus 95 will be 5%, which is going to be your net income. Now, what is moral hazard and adverse selection? We already talked about this. Moral hazard is when people get complacent, they start taking more risk than they would otherwise just because they have an insurance policy. So the policyholder's behavior changes as a result of the insurance. And here we took some interesting examples, like if you have insurance for your house against theft, you might leave your door open or you might not get an alarm installed. Or if you have health insurance, then you might be a little careless with your health and maybe you just have to, you keep going to the doctor more than you would otherwise. So how an insurance company would try and discourage this kind of behavior is having deductibles or co-insurance, where basically you don't get all of the money from the insurance company, you have to put some yourself, and the insurance company might even put a limit on the amount of money you will get from them so that you don't become careless. Now, adverse selection is from the insurance company's perspective, where the insurance company doesn't really check who they are insuring, right? And they're giving the same price, for example, to a good driver and a bad driver. So that's obviously not a good thing to do. So they want to give a different premium, a higher premium to the bad driver and a lower premium to the good driver. So to reduce adverse selection, what they should do is conduct proper due diligence. So that I gave you the example of a good driver and a bad driver. They should check the driving behavior and then give a premium accordingly. Another example that we talked about was health insurance, that you should check the health of the person, and somebody who's maintaining good health should be given a lower premium, and somebody who's not maintaining their health very well should be given a higher premium. Now, in terms of regulation, we talked about Solvency 2, and this is in Europe, right? And they specify a solvency capital requirement, and a subset of that is the minimum capital requirement, which is basically around 25 to 45% of the SCR. So first, obviously, if it capital starts falling of an insurance company, it will first fall below SCR, and then naturally they have to bring it back above the SCR. But if they are unable to do that and it keeps falling and even falls below the minimum, then at this point, obviously, the government, the regulator is going to say, okay, that's enough. You cannot write any new policies, which means you cannot take on any new business, and even your existing business might be transferred to another insurance company. And the capital requirements for property and casualty tend to be higher than life insurance because property and casualty are exposed to catastrophic risk, which is more risky compared to the longevity and the mortality risk of the life insurance companies. In the US, what we have is that this is done at a state level compared to banks, which are done at a federal level. And also for banks where you have the Federal Deposit Insurance Corporation, we don't have that. So there is no such fund that exists for insurance companies. And what happens at a state level is that if one insurance company goes down, then the other companies operating within that state, only within that state, will start contributing to a fund to compensate the policyholders of the insurance company which has gone down, right? But obviously this is not as good as the Federal Deposit Insurance Corporation, so there are limits on what can be claimed and there will be delays in settlement.